Vijay Mantri, Managing Director and Chief Executive Officer of Pramerica Mutual Funds, now joins us. Vijay, morning. Good to have you back on ET now. Vijay, it's boring, isn't it? Things are not moving. Nothing has moved on the policy front. Macro has not improved, and globally also, fund managers are not deploying money to India. They're simply protecting capital and they're sitting on cash.
Yeah, that's very true, and you can add that to the domestic investors are not investing either through mutual fund route or direct participation in the equity market. I think all these, in my opinion, are the classic sign of the market bottoming out. Today we have not only global challenges but also domestic challenges. But the interesting part is that in spite of all this, the news coming out, which is coming out pretty consistently, and most of the time the news has been bad. But in spite of that, the market is holding, and market is holding pretty nicely. So that gives a lot of comfort that perhaps market is bottoming out, and all negative news are actually factored in. So we believe that now from a portfolio construction point of view, one never know when the market is going to go up and start going up, or there's a trigger. But I think from a portfolio construction point of view, I think these are very apportionate time. However, even after saying that, one invests and one wait for 3 or 6 months and still don't see any return, and people saying that we are invested in this market for last 3 or 5 years, we haven't seen investment performance. So this market is testing people's patience. Our take is that from a valuation perspective, the market is looking very, very attractive. And the broader market valuation are very attractive, but the market have a two trend. One trend is that defensive FMCGs are available at close to 30 P multiple, which is the historical high P multiple. And then on the other hand, the other part of the market, which is available at 5 to 6 P multiple, perhaps the historical lows. So this market is a market of like 99, 2000, where IT and TMT stocks were going at far greater P multiple, and old economy stocks were available at less than 10 P multiple. So we are in that kind of phase right now. And so my opinion is that it is a market, market is going to be stock pickers market. But we feel very good about this market from a short to long-term, medium-term perspective.
Vijay, nonetheless, what do you think is going to be the possible trigger which can scale up the markets higher from here? Could it be something like an RBI rate cut, or do you think it is going to be a significant policy move wherein the markets then would cheer that?
No, I think if any of these two things happen, or even one of these happen, that will be immediate trigger to the market. But even let's assume that nothing happened on these two fronts, whether on the policy front or central bank trying to do anything on the interest rate front. But what we are seeing is very interesting. 6 months back, you speak to any economist and he would tell that the biggest concern India has is oil prices. Now oil prices come down from $125 to $90. And if it stays at $90, you will have a very positive impact on the import as well as on export over with a time lag of anything between 3 to 4 month time. A 1% depreciation in INR, in our opinion, have a 1.1% delta on the export. So export will go up and import would come down, and that will improve CAD quite dramatically, current account deficit, and that again will have a positive impact on the rupee. So the currency depreciation, in our opinion, though have a short-term impact, but the long term it make export more competitive. And if you look at the composition of India's export, if you look at 2002, only 30% export used to go to the emerging market and 70% used to go to developed market, and developed markets are facing headwind. But right now in 2012, 60% of the exports are to emerging market and only 40% exports are to developed market. So if I look at the oil price going down, if I look at currency depreciating, then in my opinion, over the next 3 to 6 months, you will see export growing up, you will see import coming down, improving the current account balance, and that will have impact on the rupee, in our opinion, and that will be, in my opinion, very positive for Indian market.
Ajay, that is more like an ideal scenario, but the realistic scenario is the investment cycle. The investment cycle has broken down, and if next 3 to 6 months the investment cycle fails to pick up, then we could be staring at a very ugly scenario.
I completely agree with you, but let's look at who can trigger that, and I think the trigger would come from the policymaker. And the policymaker, do they have any choice? I don't think they have any choice, because if the GDP grow at close to 6%, then your whole assumption on the fiscal goes for a toss, because you can't fund your welfare scheme. And understanding that 2014, is going to be election year, so we have very short time period available to the policymaker. And we believe the policymaker do not have any choice but to come out with a reform. And interestingly, we do not think these reform need any dramatic changes as far as the current regulations are concerned. If you look at the coal linkages, Environment Ministry clearance can take care of it. If you look at FDI, I think there are various things which can be done. If you look at the matter like GAR, I think we are hearing the right noise in today's newspapers, that all these things are giving us the signages that something is going to give in. And we believe that the finance minister is now the prime minister holding the finance portfolio. We would see some incremental reform happening. So there's no definite sign what is going to happen, but if you try to put all these equations in front of you and try to juggle out what is the most likely outcome, the most likely outcome to us look like that reform.
Are you still confident of your previous call, which was that Indian markets will touch a new all-time high in FY13, or you want to revisit that?
No, I don't think I need to revisit that. I think we are pretty good. We feel pretty good about it, because if you look from these levels, if you are a foreign investor, you may definitely have challenge in a domestic fund. But if you look at rupee dollar play, the money would need to come in Indian market, and you look at valuation which are very attractive. And these things changes in 1 month or 2 months. You see some 7-8 good trading sessions and a lot of confidence built in. So we believe that the FI money would come into Indian market, because now they don't have a currency challenges, because rupees at 57, 58, around 57 level. Domestic participation, we believe that whenever the market are at these level, people continue to invest in the market. So I think that money would continue to come in. The SIP inflows in mutual fund industry, though it has come down, but it's still pretty persistent. So that money will continue to come in. And you don't need big amount of dollars to take Indian market to new level. Suppose you get $1 or $2 or $3, $4 billion, I think that you could see 10 to 20% appreciation in the market. And one more important factor one need to keep in mind is that interest rate already started coming down. If you look at 3-month bank CD, they're already down by close to 75 basis points from their highs. The liquid fund and the debt return would come down on incremental basis over the next 3 to 6 months. Real estate is not going anywhere. Gold at 30,000 level. So where we look at investing if you want to have a 15 to 20% return on the portfolio. So I think in our opinion, we stand firm on our call that over the next 9 to 12 months, the Indian market would touch the new highs.